All right, for the day's market movements and some pointers as to where or how you should be positioning in the months ahead. Marcus Bogdan joining us from Blackmore Capital. Marcus, good morning to you. Yeah, volatility is the name of the game at the moment. You're expecting this to continue at least, because October is living up to its name, much like September, isn't it?
Good morning, Andrew. Absolutely. I think what we're seeing in September and what we're seeing in October, I think the balance of risks is on the downside in terms of we're seeing earnings slowing. EPS forecasts have been downgraded from a peak in August of expecting 15% growth for this year to around 10% today. So I think that trajectory of travel illustrates concern over earnings. And at the same time, as your previous guest has highlighted, there are growing concerns around inflation and the bottlenecks and the impact that that is having on the wider global economy.
All right, so that then takes us to how you position your portfolio to, with those elements in mind at the moment. Do you go defensive or are you seeing opportunity with those growth stocks?
Our basic tenet is that yes, we do want to be more defensive. We want to be focused on quality, but also value as well. And we're seeing that through the illustration in the energy stocks and the recovery there. We also want to be positioned in companies that have got pricing power, that they've got the ability to pass those prices on, even though they're seeing higher input costs. Companies such as Amcor and Brambles. Notwithstanding that, I think if there is an overreaction, then we have to be mindful of some growth stocks as well.
All right, okay. Well, let's get a little more specific then and look at those stocks that you're looking at the moment. And of course, REITs, it's all about income. You're looking at Waypoint. Now, it's the largest owner of service stations across the country.
Yes, they are, and they've had an earnings upgrade most recently. Earnings growth almost expected to be around 4% for this year. Why we like this company is that it has a very long lease expiry profile over 10 years. So that gives us comfort in terms of the cash flows that we're expecting to receive over the next decade. And also they have 3% escalators in their rentals, and so that will flow through to growing distributions over that period of time. So Waypoint is priced at a price to book value of about 1 times, a dividend yield of 6%, and we expect that dividend will grow at around 3% per annum over the next 10 years. And for that reason, we still like that company.
How are you looking at the broader REIT, well, more broadly at REITs at the moment, I guess, because I guess it depends on where you're looking, isn't it? Because industrial's obviously done very well, but there's still a big question mark over commercial and office.
Absolutely. So we do favour the industrial side through Goodman Group, their ability to continue to grow earnings per share of around 10% per annum, and they've got such strong tailwinds behind that business. And as we said, the other REIT that we own is Waypoint. We're more cautious, more broadly on property, particularly with rising bond yields. So the evidence is that we need to be highly selective at this point in time.
Now, Marcus, of course, if you do want to go defensive, healthcare is always a good sector to look at. You're taking a specific look at Integral Diagnostics. Now, it has just recently acquired the X-ray group. What are you seeing here?
Well, we do like healthcare, and we've got an overweight position in the portfolio in healthcare. And we have started to look at the diagnostic side, or the imaging part of that market. Integral is one of the leading groups in Australia and in New Zealand for radiology services. It's growing at around 6 to 7% per annum organically. And then it's been quite acquisitive, as you've just pointed out with X-ray. And so we expect that this company can grow over the forecast period of around over 10% per annum. It's got a strong balance sheet. And we also expect to see margin improvement as there is a push to more sophisticated testing in areas of imaging.
Yeah, okay, because I mean, you would have thought perhaps that it perhaps may have suffered during COVID, particularly as people put off some screening processes. However, it's actually done quite well through the COVID period, hasn't it?
Yeah, I mean, I think what you're saying is absolutely valid, and they have had a 15% contraction in their underlying business through COVID and through these lockdowns. But what that does mean is that there is a huge backlog, and they expect that 70% of those patients will come back into the market. Plus, you've got forward projections of new patients to be treated as well.
Marcus, good one. Thanks for joining us from Blackmore Capital.
Thank you, Andrew.